Today's Talk About It Tuesday question is, with rumors of recession on the horizon and inflation rates continuing to rise and the Fed's failing to slow it down, some people are considering moving their funds into commodities such as gold and silver. I believe you've spoken about this once before regarding ways to hedge against inflation and ways to best protect your nest egg. Would you consider gold, silver, or something else like real estate to get you through a recession? All right. So I don't know why people think my stance is going to change. I have an overall strategy for taking advantage of great economic times, stagnant economic times, and bad economic times. And that strategy is consistent and never changes. So let's talk about this idea of gold and silver as hedges against inflation. So historically, we have seen people use gold and silver to hedge against inflation. What does that mean? There has been an inverse relationship, meaning when the economy goes down, inflation goes up, then people will take their money out of cash because, of course, when we have inflation, you're losing purchasing power. And so they take that excess cash and they stick it in gold and silver. And it has worked in the past because there was this idea, this belief that gold and silver were real money. And where did that come from? At one time, gold and silver were actual mediums of exchange. You could actually take a lump of gold or gold powder, gold dust, or silver, and you could actually purchase something with it. And so when we switched to it, and at the time they had paper money. Paper money was a note, meaning because it was lighter to carry, this is a note that represents a certain amount of gold or a certain amount of silver. And if you turned it in, you could actually get the physical gold or silver. So as we moved to a fiat system that was not backed by gold, but backed by the health of the economy, basically, and the well-being of a country and the government. When we moved to the paper system, a fiat system, there were people who came out of that era when gold was actual money and their children. And those people still held on to this emotional attachment to gold and silver. And so when the paper wasn't doing well, for some reason, they thought that the gold and silver was this salvation and store your paper money back in the rock, because that's all it is, hunks of metal, some rock, and that things would be all right. And there's no intrinsic value in a rock or a piece of metal, shiny metal, any more than there was in a piece of paper. And so what happens, and there's a thing called Planck's principle, right? And Planck's principle basically breaks down and says that even when new truths are brought about, people's minds about what they believe don't change. Those people just die off. And so what we're seeing today, because gold and silver are not acting like they did in past economic downturns. As a matter of fact, their prices are going down. What we're seeing is the generation, I think the last generation, the baby boomers, and a little bit of Gen X, who would flock to precious metals in economic downturns, they're just not in the game anymore. So most of them are aging out. Many of them are dying off. And so that attitude, that belief that, oh, I need to go run, put my money into a rock, that attitude is gone. And then we have the extreme on the other end, which is, the post-millennials, the Gen X's, the Gen Z's and Y's and Z's, and they ran to cryptocurrency. And my feeling on that. It's the same as a freaking rock, right? It's the same thing. Has no intrinsic value. Is not acting like a hedge against inflation. It's plummeting the same way, even worse than precious metals. So my generation, the Gen Xers, we have a different type of strategy and a different type of model. And it's really about diversification, right? And so if you have a well spread out portfolio, meaning if you always have money in risk assets, which stocks, or you always have money in fixed assets, which is interest income, if you always have money in real estate, and I don't believe in throwing money into precious metals and collectibles and things like that, because those values are based on emotion and you don't get any cash from those. So the big three. If you always have a well-diversified portfolio in those three major areas, asset classes, then you can take advantage of any economic situation because economies are always cyclical. And so even in those areas, so let's say stocks, most people are running from the stock market because they say the stock market is doing bad. No, the whole stock market is not doing terrible, because most people don't even diversify within that class. And so we saw a whole bunch of people put all their money into the what they call the growth stocks and the big tech stocks, right? And those are doing poorly now. But what's doing well? We still have healthcare doing well. We still have consumer staples doing well. We still have energy sector doing well. So we still have areas that are doing well. So the thing is, you rebalance your portfolio. And so you take it out of those big growth stocks and put it into the value stocks, the consumer staples, the energy, the healthcare, put it there. So you just rebalance your portfolio in your stocks. And then you rebalance some of the money you had there and you put it into fixed income. Fixed income, meaning bonds, did poorly for many years, but interest rates are going up. So we know the Series I bond is booming. And so we stick some cash in there. We can look at other interest incomes like crowdfunding. And so we have to we say, okay, we had money in crowdfunding, maybe because real estate's going down, crowdfunding might not do as well, but maybe there are areas where you can do some interest income with some types of secured loans that you have out there, and you can get paid from that. Less risky. We also want to look at real estate, but we also have to look at our real estate portfolio, and maybe we shift from that. A lot of people were vacation rental heavy, and maybe as the economy slows down, people won't be able to go on vacation as much, and so you maybe shift your portfolio into traditional rentals. But the thing is to always have money in the big three, and it's just how you spread it out in the big three, and then how you shift and rebalance your portfolio. To me, that's the best way to hedge against inflation. To take everything and stick it in a rock, I think that's such an old, outdated way that certainly is not working today. To stick it in any collectible, people ran the NFTs for me, how I feel about those things. So any fad thing, anything where the masses are running to it, I say run as far as you can from it. I think the best way to hedge against inflation, and at the same time, the best way to take advantage of economic upturns and the best way to make money in stagnant economies is exactly the same. Your financial strategy has to be well diversified asset portfolios in each of the big three asset classes, and even within them to diversify as well. So I'd love to hear your comments. I'd love to hear your strategies and your theories. Keep the questions coming. Please like, share, and subscribe, and I'll see you next Tuesday.